Hello, I'd like to extend a warm welcome to everybody who has joined us for ACPM's 2024 Roundtable broadcast. I will be firstly introducing our moderator, Steve Mahoney, who is the Chief Investment Officer at the Nova Scotia Pension Services Corporation. And Steve's also been a member of ACPM for many years and has served on our board. Steve, before I pass it over to you, just two quick logistical things for the folks on the phone. Probably the number one question we get is, will we get the recording? And the answer is yes. So you don't need to scribble madly. There's a lot of information in this presentation to come. And secondly, questions are a little bit different today. So if you have a question, and I know our panel welcomes questions, please write them to questions@acpm.com. That's questions@acpm.com. But Steve, I'm going to hand it over to you to take us through the next hour, please.
All right, great. Thank you very much. And good morning to our friends on the West Coast, and good afternoon to those of you on the East Coast and the West Coast, which is the Atlantic coast. Happy to be here today. Pleasure to be moderating this session. Some very topical things that we're going to be working our way through. And I'm pleased to be joined today by Ryan James Boyle, who's Senior Vice President and Chief U.S. Economist at Northern Trust. Eric Moret, a CFA Senior Research Analyst with CIBC Asset Management, and Wiley Tollett, the Chief Investment Officer of Franklin Templeton Investment Solutions. And so today we're going to be going through this presentation and taking questions on the back end, and we're certainly excited to bring a fair amount of content to you over the next hour, 45 minutes to an hour, and then have some further discussion. So gentlemen, thank you very much for participating in this today, and happy to begin. And we're going to begin with, of course, what I think is possibly the most exciting development that we've seen over the last couple of weeks. Is certainly all that people seem to be able to talk about, and that is the U.S. election, right? And it certainly is the elephant in the room. This chart's a little bit dated now, but it was certainly was being updated live during the presentation, and Ryan has some further slides on how the House and the Senate developed as time went on as well. But certainly, I just want to open up the floor at this point in time and ask you all sort of, were you surprised by this election? Is this what you thought was going to happen going in? What sort of scenario did you put on this? And we'll get into some of the implications of this election as we go. Perhaps, Ryan, we can start with you.
Sure. Hello from Chicago. So here, I hope joining a Canadian webinar might give me a reprieve from U.S. politics, but we won't be able to get away from it for quite some time. Candidly, I'm not just trying to be apolitical here, as is part of all of our remits. Tuesday, election day, I had no idea what was coming. I felt that any outcome was possible. I thought it would be closer than it was. I did not know what to expect. And I got to be honest, we've settled, one question, I guess 3 questions, including Congress, but I still have no idea what's next with any precision. But we're evaluating a lot of risk cases that we'll dig into today.
Thank you. Eric?
For us, the biggest surprise is really the red sweep. What it means is more pro-growth fiscal policy, more deregulation, more curbs on immigration. So overall, it's positive for growth in the U.S., and it's also positive for inflation. So for investors, this should bring some challenges.
And Wiley?
Yeah, we also were somewhat surprised, although sort of the red sweep was one of the scenarios that we had anticipated. That we were sort of hoping, and actually our most likely scenario was a split. We knew we had a bet that Trump was in fact going to take the presidency. The betting markets correctly predicted that. The polls did not, but the betting markets actually did, and they're proving to be a sort of offshore betting markets where it's legal to bet on the outcome of the election. They've proven to be actually more accurate than many of the polls. But we had been hoping for a divided government because we think that would have put some boundaries around the outcomes. Now we have a red sweep, and so I think that should be a topic of the conversation today, how that unfolds. Based on the last Trump administration, very difficult to predict how it might unfold.
Yeah, exactly. Yeah, it's certainly, I don't want to call it distressing, but when the betting markets are smarter than the pollsters whose job it is to predict elections, it's certainly an interesting development. But as we move along here, what we want to get into is a little bit about the economy, right? And the effects of a Trump administration on the economy obviously will come into play, but there's also things happening around the world. And what we're going to speak to, first of all, is just something about, rates and demand. And Eric, I think we're going to turn it over to you here just to talk a little bit about what we're looking at here.
So this is an important chart. It's just telling you that we expect the ratio of investment as a share to GDP in the US to increase to where it was before the great financial crisis. And the link with the red sweep is the following. A red sweep means potentially more growth-friendly fiscal policy, more inflationary measure on immigration, and more tariff and willingness to implement measure that would facilitate reshoring into the US. So the key takeaway of the election is that it is reinforcing our secular view on the US economy of US exceptionalism, which should result in a higher investment to GDP ratio. Several factors should bring that ratio up in upcoming years. We have first lower rates that should unleash pent-up demand. We have also a secular housing shortage in the US, but we also have an infrastructure gap. So there's a lot of needs for investment and infrastructure upgrade in the US. There is a tech boom, AI, robotics. There is also the de-risking need from the US, so to de-risk from an excessive reliance on China regarding supply chain. So there's a lot of factor that should bring that ratio up. And really, for the US, we have over the medium term more US exceptionalism, and the re-election of Trump should reinforce that view looking ahead. If we go perhaps to the next slide, something that is important to that view is the fact that labor market have rebalanced in the US, but they remain tight. And this is extremely important because there is still excess savings in the system. Tight labor market will allow household formation, meaning more housing demand. And the fact that labor market remains tight has also an implication for the Fed. It should keep the Fed concerned about cutting too much. It should keep the Fed risk averse about the second round inflation waves. And so what it means is if we combine this slide and the other one, our outlook is that the Fed cannot cut its policy rate below neutral. It has to keep it above neutral. But this is a good problem because fundamentally it's because of strong growth and an healthy labor market. So that's our overall picture for the US. And that is really a positive factor for investors over the medium term.
Yeah, and what we're seeing here, obviously, we're seeing different outcomes, and when it comes to Canada versus U.S., when it comes to rates and cutting, we seem to be a little bit more of the mindset here in Canada that we're cutting. The economy is not as strong. We're not seeing as much growth. We're not seeing as much resilience. The United States, we're getting a much different picture. Maybe Wiley, you can speak a little bit to that.
Certainly. So we had strong growth going into the election, actually, and so we saw a little bit of a slowdown in the midsummer, but starting in August and September, we started to see renewed investment, current leading indicators ticking back up for the U.S. That's a particular data set that we follow closely in our asset allocation, in our shorter term asset allocation cycles. So we saw a pretty good growth, solid employment and inflation trending down. All of those were positive, so kind of tailwinds all around for equity markets. And then the election, despite not necessarily always, of course, it's never to everyone's liking, but the fact that we now know the outcome removes a great deal of uncertainty. And as we all know, markets hate uncertainty. And so removing that uncertainty, we've seen a little bit of that rally occur both pre-election and now post, with a bit of a give back last week as the sort of red sweep became more evident. So I would say, again, over the short term, we're positive on equity markets. We're actually a slightly overweight our strategic allocation over the near term, probably through the beginning of the year. We are concerned about the fiscal balance in the U.S., and I know we have more discussion later in our conversation around the fiscal balance. And the fact that many of Trump's policies or proposed policies, such as deportation and tariffs in particular, look inflationary. So we're concerned about sort of a repeat of some of the second wave inflation cycles. That happened in the 1970s. We know the Fed, to Eric's point, is following the playbook from the 1970s very carefully. They're looking at the mistakes that were made and trying to not repeat those mistakes. So we think the Fed versus the fiscal policy, sort of government executive branch policy here in the US will be very important to watch over the medium term. And then lastly, over the longer term, say the 5 to 10-year cycles, what we're seeing is longer term equity returns slightly down actually from where they were just coming out of the pandemic. And that's because we've had a pretty spectacular couple of years. If you look back, we've had a 51% return on the S&P 500 over the last 2 years, 36% sort of over the last 12 months, measured just a few weeks ago. So that's a pretty remarkable set of returns. And again, exciting developments in AI, good growth, declining inflation, reducing, shorter term interest rates coming down, a lot of good tailwinds, and those, but that we think that's largely been priced in, and we expect more muted returns sort of over the medium and long term for the U.S. equity markets.
Well, that's great. And maybe we can turn over to Ryan. So picking up on the point of American growth, perhaps you want to speak a little bit to why we're seeing such growth in the United States and a continued growth, really, that sort of confounds a lot of us investors from other parts of the world.
Yes, happy to start there, and really good lead off here from Wiley and Eric. I say with some pride, we put out a monthly forecast at Northern Trust, and we never called for a recession. And a couple of years ago, that was a really difficult call. We were challenged heavily, robustly.
You were
but
one
we
of the few, actually, Ryan. Everyone was calling for a recession back in early 2023.
And every model would predict it because all the past cycles said we can't pull off the soft landing. 2 years ago, soft landing was a punchline. And even a year ago, it seemed too good to be true. But here we are. The soft landing is inflation coming from an elevated level, getting back under control without widespread economic damage, without job losses, without a recession, without just some sort of calamity, bringing about a fall in demand that is the reason that inflation cures. And part the reason is the inflation came from a series of supply shocks. So many of the past case studies we could go through, all the cycles since post-World War II, were largely demand shocks. So this time it was different. And I'm reminded of this dichotomy. It's often said the four most dangerous words in investing are, it's different this time. On the other hand, maybe the 12 most dangerous words in investing are, the four most dangerous words in investing are, it's different this time. History is the study of things that haven't happened before. And look at this, we're living through history. The fears were widespread. The risks were widespread. We dealt with global shocks. Showed just how resilient we could be in the face of a global pandemic and a global round of inflation, putting every economy at risk of a recession. And that risk was a lot more proximate all around the world. We saw the UK go through a brief cyclical recession. Germany may be on the cusp of one. They keep flirting with negative GDP and then pulling back. But the US has pulled apart after a pretty synchronized global trend, 2020 through 2022. Then we pulled ahead. And I credit a lot of this partly to our population growth. We can talk about immigration later if you like. There's a lot of productivity here, but also on a very simple basis, we are good at hedging our exposure to higher interest rates. Every central bank responded very similarly to the similar set of shocks. They have a mandate to contain inflation. Let's raise interest rates, try to cool demand. Well, in the US, we tend not to feel it. Households lock in their mortgage rates for 30 years. So when the Fed raises rates, most households don't feel it. We don't carry very much floating rate debt. And on the corporate side, there was a lot of debt issuance back in 2021 and 22. We knew rates would inevitably rise. We didn't know how soon, didn't know how much, but let's lock in these low rates while they're available. So we do worry a bit about the maturity wall down the line, but thus far it hasn't really been an issue. And now we've entered a falling rate environment, so hopefully we should be able to get through that. So those are the key reasons I see as the US having pulled ahead. It's enough progress to get the Fed into a rate cutting cycle. Employment is holding up. Inflation seems to be contained. I think we'll have a lot to say about inflation as we progress through this discussion. But it does seem risks to inflation are mounting on the upside. It's hard to see a lot more gains, hard to see it falling much further. Hard to see much further improvement when I look at housing, when I look at services, and certainly when I look at goods as we're digesting the risk of tariffs. So we want to proceed to the next slide. Just a few top level risks we are tracking. As we said at the outset, it's the red sweep, gives us some certainty about policy direction. But you can see here in the lower left, exit polls of what was on voters' minds as they voted. Inflation was number one. As much as I could say inflation has improved, we can all pull up charts that say, wow, we're almost back at that 2% target. We've come so far. That's not how your average person or your average voter thinks of inflation. We think about price levels. I want my 2018 prices back. And as we all know, that's not how inflation works. We look for someone to blame. In this case, we blame the incumbent president for better or worse. There's not a whole lot the president can do about price levels. The president does not control prices, and let's be glad for that. We don't live in a command economy. Biden did what he could in terms of, releasing petroleum from the Strategic Petroleum Reserve, but ultimately this was just a supply shock that had to work its way through. Everybody got raises. The president doesn't get credit for that. But we look for someone to blame for higher prices. So we're past the worst of the inflationary cycle. We'll see where it goes from there. But now, as we consider risks around tariffs, likely to be a price shock to goods. We just don't know exactly which goods and to what extent they'll be implemented. We have to worry about labor availability. We could see some wage inflation if we really do curtail immigration. And finally, we have to watch yields. We saw fixed income markets react strongly to the election outcome. That is a higher cost of financing that could prove to be inflationary or could prove to sap demand. So those are the risks we're monitoring, and happy to dig into those in greater detail as we continue the conversation.
That's great. Thanks, Ryan. And Eric, just to pass a little fun one over to you. Sort of when we think about politics, unfortunately, for fair and not fair, we define things as left and right. And here for the United States, the red for Canada is blue, and vice versa. Do you view as politics seems to be moving to the right around the world? There's an upcoming Canadian election in the next 12 months. Do you see something happening similarly, where I guess it would be more of a blue sweep, which would be equivalent to a red sweep?
That risk is increasing because of high inflation, sticky inflation, and also due to the fact of elevated level of prices. So people want to blame politicians indeed, and so there is a risk that Canada is turning right, and also there is frustration in Canada regarding the housing problems, the shortage, and probably that this could mean an election of the Conservative Party in Canada. So this is where we could be surprised. And in terms of policies, one key challenge that Canada is facing is that it's difficult to ramp up housing supply quickly. So the inflation or the shortage problems that Canada is facing regarding housing is something that will likely remain for several years. The good news is that Canada the shortage of housing should mean a lot of investment in upcoming years. So over the medium term, that this is something that is positive for the Canadian economy. So that shortage of housing is something that could influence the election, but over the medium term, it's something that will result in more housing construction. And the old adage is that housing is the business cycle. That should be a key tailwind for the Canadian economy looking ahead.
Well, that's great. Wiley, we're going to turn over to you just for a second. So putting a lot of this together, I think you've all sort of each got a little bit of a forecast from a macro perspective. Maybe you could speak perhaps to Franklin Templeton's.
Yeah, certainly. This sort of summarizes our current sort of macro views. And maybe before I progress into this, I'll answer the last question just to sort of get the debate going. But one of the things that characterizes the Trump administration, and I think actually characterizes a lot of what looks at the surface like a red wave kind of starting to encircle different parts of the globe, including Canada, is that it's not the red wave from the Reagan era. It's much more of a populist tone. And populism historically is not exact. So in other words, this is not your father's Republican Party. And I think that's been evidenced by sort of some of Trump's cabinet picks, as you've seen. They're really quite an interesting bunch of folks, and don't necessarily support traditional Republican ideals like like the support of business, for example, and lower regulation, and perhaps capital over labor, if you're thinking about it in traditional economic terms. Populism. So the Republican Party has completely shifted in the U.S., and that's taking place in other parts of the globe, in Poland, in Hungary, even in parts of South America, like look at Argentina. populism is on the rise, and it has done this in the past. Every 100 years or so, a populist wave comes, and it doesn't usually work out that well, actually, to be honest with you. Because it has sort of very, very divided views around the support of capitalism, around labor versus capital, taxes. All of those things are a little bit muddied in the world of populism. And for example, generally immigration is positive for economic growth. But when we put dramatic curbs on immigration, when we have a sort of a local population that's not growing very rapidly, that can really actually hinder economic growth over the medium and long term. So I think that sort of short term, positive deregulation, all of those things, but longer term, I think populism is something to keep an eye on if you're an investor. Very important to not sort of think that is a pathway to solid equity returns. And it also has a history of causing issues in the government bond market. So that's certainly something we're watching very closely. Back to my sort of macroeconomic themes. And I do think these are all relevant certainly over our, say, the next 2 quarters, our 6-month, what we call our dynamic asset allocation horizon. At investment in the Franklin Templeton Solutions team, we have 2 high-level timeframes we look at: 6 months, which is kind of our dynamic allocation, where we're trying to lean into and lean away from certain markets to either add risk or back away from risks that we perceive over that relatively short term. And then we have a longer term strategic asset allocation horizon where we've published capital market expectations. That determines our longer term asset allocation. Both are relevant, I think, in many investors, including pensions, can avail themselves around those 2 different time horizons. And we like that sort of defined way of looking at the world. So over the 6 months, we think, again, growth remains relatively constructive. Inflation risks are balanced. As Ryan indicated, we saw a steady decline, but we've seen some sticky areas. And as Eric mentioned, housing, which is also an issue in the US, there's not enough of it. We've had since the financial crisis, we've underbuilt. So there's a significant population of younger people that are having a very hard time finding a starter home that they can afford. That was an issue in the election and continues to be an issue and will be for some time. Housing starts, have been slow to recover for a variety of reasons. And then finally, the interest rate cutting cycle, which earlier in this year we thought was going to be quite aggressive and continuing into 2025, the Fed is already sending signals that they're slowing down, even questioning whether there's going to be a December rate cut at all. And so we still see interest rates declining, shorter term interest rates declining, but we also see some medium and longer term issues in terms of longer rates, maybe not declining to the extent people expected, maybe staying a little higher, including the term premium, slightly higher inflation, and a lower, what we call neutral rate of higher neutral rate of interest, kind of keeping the cost of capital a little bit higher, a little bit longer. Not enough to slow down those short-term animal spirits, though, but enough to keep an eye on for the medium and longer term.
That's great. One thing I want to talk about is inflation. You've all sort of hinted at inflation's come down, but it sounds like from what I'm hearing, most of you think it doesn't have much room to go further down, but it certainly has the room to come back up. And I just want to speak to, as I turn slides here, as I make sure I can, this is one thing that concerns me, right? Is the Middle East a potential catalyst for an inflation increase? I want to bring in Ryan just for a second before I sort of set the tone here. So we certainly, are concerned about, continued wars. Trump has promised he can end all wars. He's a president of no wars. He's going to end the Ukraine-Russia, crisis in one day. I'm not quite sure how the Middle East plays out. There's certainly a lot of complicating factors here. But if the Middle East goes into a full-scale war, do you see that as inflationary? And perhaps, Ryan, you can speak a bit to your thoughts on inflation.
Yeah, I'm glad you started there because this is something I worry about every day as I wake up and check the news. Did anything get worse in the Middle East? I'm amazed how energy markets have pretty well shrugged off a conflict at the doorstep of OPEC. So the fear of the Israel-Hamas conflict spreading more thoroughly into Iran or into other major oil-producing nations could be a huge disruption. We saw this in 2022. Russia was sanctioned by Western nations. They didn't even stop producing oil, they just redirected it. Stopped selling it west, still sold to the east. Russia accounts for what, 8% or so of the world's oil output. Not exactly a huge player, but just that disruption alone of rerouting oil sent commodities markets going wild. So absolutely a risk. And yes, that would be inflationary. And to the extent I sounded optimistic in my overture, that would certainly make me reevaluate some of my priors. If we saw rapid repricing of oil, we would feel inflation again. It would be really hard to contain. We have come a very long way on inflation, and we should be proud of that progress in a pretty globally synchronized manner. But yes, I'd agree. It's hard to see significant further gains from here. I tend to think of inflation across three broad categories. Shelter, this has already been mentioned. Housing is in short supply. I absolutely agree with Wiley. We underbuilt. In hindsight, it was rational. A lot of people got burned by the US housing crisis. There was not a lot of appetite to build more. So we were too cautious about home building. Now there's not enough. And yet higher rates are depressing home starts. I'm always surprised by this. Just in my simple economist brain, we don't have enough housing. We have a lot of demand for it. Shouldn't we see more housing coming online? But housing starts are not there. I think potential buyers are waiting for lower rates, justifiably, and home builders have seen their costs go up. It's a higher carrying cost. They're using short-term debt, so they're more hesitant to break ground as well. They want to see a firmer economy, thus hard to see shelter inflation getting much better. Services, the number one input to service prices, wages. Wages are still gaining at a faster pace than we were accustomed to before the pandemic. Two sides to that coin. Everyone likes getting a raise, but that cost has to be passed on to final prices. So I don't see services improving a whole lot more from here. And lastly, goods. Goods are currently deflationary. I'm not sure that can persist. Goods deflation was a main reason that we didn't worry too much about inflation before the pandemic. We got so good at producing everything wherever in the world it was most cost effective to do so. We shipped the raw materials and intermediate goods from around the world to exactly where they needed to be within a day of when they were needed. It's amazing. We wrung so many efficiencies, but we didn't realize the risks that we introduced. And those global supply chains were fragile. And once they broke, they were really hard to restart. So now we're thinking more about just in case rather than just in time. Maybe diversify. Don't just produce in China. Think about China plus one. How do we build some resiliency into our production? All of that is by definition more inflationary. Then add to that what was already a tense trade environment. Trump's been president once before. He put a bunch of tariffs in place. They're still in place. Biden kept them all there and just not only added marginally to tariff policy, but redirected more U.S. industrial policy to support domestic production. Now we've got Trump coming back, talking about tariffs. We don't know exactly what shape they'll take. He threw out a lot of numbers, not precisely. The Republican Party platform didn't contain numbers and didn't really emphasize tariffs, just more said we want strategic independence from China. It mentioned a blanket tariff, but without putting a number around it, and that may legislatively be the hardest one to pass. So we can expect day one, even before inauguration, I'm sure we'll see tariff threats, but threats themselves can help negotiate, get some concessions out of our trade partners. Maybe that alone will be enough, but I don't think we've really defined the objective of the next phase of the trade war. But there again, it's just another reason to expect goods prices get a bit higher. So where does the further improvement in inflation come from? I'm not so sure. The Fed, like many central banks, has a 2% target. It's going to be hard to reach it and certainly difficult to stay there. If we enter a world of 2 to 3% inflation, 3 to 4% wage growth, that's sustainable. That's not the worst possible outcome. There's just a risk once inflation is at a more elevated point. There's a risk that it does take off a little more easily. So the Fed will never say mission accomplished until they're back at 2%, but that may be quite a while away.
Great, thanks, Ryan. And I think a couple of things that everyone's sort of hinting at or touching on are trading partners, tariffs, other places in the world, and inevitably we have to talk about emerging markets, China and India. And so in the interest of sort of moving along, just a quick chart to show people sort of China's major trading partners or countries that have become very reliant on China. And you can sort of see around the South China Sea and into into the sort of parts of the world you see India there. And so I want to turn over to Eric to speak to a little bit to about China and India. Obviously, people who are emerging market investors saw China ride very high for a couple decades and now it's pulled back a bit while India has grown as well. The two of them have always accounted for somewhere between 40 to almost 50% of the emerging markets index. So perhaps Eric, you can jump in here a little bit.
Thank you. Regarding China, it's difficult to be optimistic about China from a growth standpoint. But the good news is that we see limited downside because we consider that for policymaker, the pain threshold has been reached. And this is because the housing market is in an ongoing contraction that has been underway for more than 2-3 years. And this is posing a risk to financial stability. Trump has been reelected. He will most likely put tariff, and we expect China to respond with a more convincing stimulus. Not a bazooka like in the past, but something more convincing in terms of stimulus. And the key point from China is that we see limited downside on growth next year. And also one thing that is important with China is that yes, it's been hit by the US with tariff and de-risking and decoupling, but China has been gaining market share across emerging market. And as you shown on the chart, and this is something positive for China. And in that context, the Chinese economy should remain resilient despite the lingering headwind. Turning to the rest of Asia, what we have is a picture of resilient growth, limited current account imbalances, tech exposure that is increasing, countries that are moving up the value chain. We have also a beneficiary of trade diverging. So some Chinese companies are moving away from China to go to other emerging market countries. So we have tectonic plates that are moving in Asia that are negative for China, obviously, but that are on the other end positive for the rest of Asia. Where we see the biggest winner is really India. India is at a growth stage similar to what China had 2-3 decades ago. The chart just shows the GDP weight for India. That's the burgundy line. And it's comparable to the gray line on the right axis. This is where China was 25 years ago. And currently, India is the 5th largest economy. It's going to continue growing. It's the most populous economy with young population, deficient infrastructure, from basic infrastructure to power grid to sanitary infrastructure. So there's a lot of inelastic demand for investment in India. And as a result, over the medium term, India will become a key driver of commodity demand growth. So it's likely to become the biggest contributor to demand growth of several commodities over the next 5 to 10 years. So this is a secular tailwind. And as a result, despite the Chinese lingering problem, emerging market, especially in Asia, are moving up the value chain. Trend growth remain attractive. They should benefit from friendshoring. So the US cannot reshore everything back. So they will need friends and allies. And this will benefit many countries in Asia. And one asset class that is attractive over the medium term and over the short term is really emerging market debt because of high carry or high income with lower risk than the historical average.
That's great. Wiley, perhaps from your perspective, your thoughts on India, and then on the friendshoring, I'd ask, and any one of you if you want to jump in, what are thoughts on Mexico? Sort of people think that Mexico will benefit very strongly from being the United States' current, largest trading partner and having close proximities.
Yeah, happy to talk about this. Actually, I've been with Franklin Templeton, since 1994, so a very long time, and during that time, we've expanded globally, through the purchase of Templeton originally, which had offices all over the world. So I've had the great benefit of visiting, most countries in the world through the course of that career. In fact, I was just in Beijing like 2 weeks ago. And there was a couple of things. I've been in Beijing multiple times. In fact, the last time was in 2013. You might remember 2013 in China was kind of the peak of China being the next largest economy, next largest market, the destination for global investment capital. The luxury stores were full. Everyone in China was buying BMWs and Mercedes. It was quite a the thought was China was ascendant at that time. Having just visited 2 weeks ago, I can tell you it is a very different country in 2024 than it was in 2013. Beijing was probably the best word I could describe it, was very muted. And I think that, as Eric mentioned, the stimulus package was too small to really dramatically impact real economic growth and stimulate domestic demand. We're not seeing domestic demand really recover. The pandemic really caused people to pull in their reins a bit in China. The domestic consumer is still very, very cautious. Unemployment is still higher than is kind of captured by many of the statistics. The housing market is still moribund. There's still excess inventory. So a long way to go in China. And I might also add that even as that economy eventually recovers, which we believe it will slowly but surely with additional stimulus, that doesn't necessarily translate to meaning markets there will recover. The government is actively trying to sort of diversify away from Western capital markets. And we noticed that in conversations there. And so I think it's important they still will have active investors in China, but their own domestic capital markets, we think, will be constrained, might be the best way to frame it. And so China economic recovery will benefit many areas of the world, particularly in the East, as that earlier slide highlighted. But I would be very cautious as an investor in terms of China really taking its place amongst the global capital markets. I think that will be a very, I think, rocky path. India, on the other hand, and actually Franklin Templeton's largest employee base is actually in India. I've been there many times, and we have quite a substantial footprint, both as an investor, as a manager, and as sort of as an employer in that region. I'm very bullish on India. It has a lot of challenges. Obviously, infrastructure, regulation is very challenging in the country, but it has a well-educated and available workforce at the top of their population. They have excellent universities, particularly in tech, science, and the STEM disciplines. And so I think we're bullish on India. We're bullish on Indian growth. We think longer term Indian markets will continue to do well. And we believe India really, their demographics are also very positive. So long story short, we're long-term bullish on India. Shorter term, it's also had, it's had its challenges. It's had higher inflation and sort of domestic demand. It fluctuates, very sensitive to inflation. And so but I think we're a bit cautious shorter term, but longer term, quite positive. Related to your second question on Mexico, we've seen the Mexican, the peso really sell off recently following Trump's election. And that happened last time, by the way, but we're bullish on Mexico as well. We think, again, the proximity to the US, one of our they're obviously a friend, in terms of allies, along with Canada. They're part of the North American sort of trading alliance. So we're overall bullish on Mexico, medium and long term.
Yeah, Mexico is going to be an interesting one to watch. I'll jump in right there. The trend is obviously away from total globalization and more toward nearshoring and friendshoring. So yeah, we've got a long-standing free trade agreement on the North American continent. And we've seen a shift in trade relations where the US is now importing more from Mexico than from China. It's quite a change in dynamics. So, what happened there? Did we invest heavily in Mexico? Did we strategically decide to buy more? Or are more goods finding their way from China to Mexico than to the US? Hopefully, it's not just simple transshipment where you're using a port in Mexico and shipping up. There are protections in place to prevent that, but there has been direct investment from China into Mexico, try to build more within our free trade zone and allow that to be an entry point to the US. We can expect the Trump administration is going to look very closely into this. And there again, a point of bipartisan agreement. Biden was starting to crack down on exactly that strategy as well. Also, a lot of tension. I mean, the number one issue for the Trump campaign was immigration. Point number one in the Republican platform, seal the border in all caps. And I expect that's happening on day one. They're going to look to Mexico as part of the problem, even if it's a lot of refugees fleeing countries, in Central and South America that are in a much worse state. And it is a humanitarian crisis. I don't want to make light of that, but they are making their way through Mexico. The Trump admin is going to lean on Mexico to do more, and they have a bargaining chip in that the U.S. Mexico-Canada agreement is up for maybe not a full renegotiation, but there was a term in it that they'll revisit in 2026. So that could be an opportunity to say, look at the investment you're poised to lose unless you crack down. So they have a new incoming president, or excuse me, Claudia Sheinbaum has taken office now. A rare example of not a party change in a presidential election this year, and she'll have her work cut out for her.
Great.
Perhaps a few words on Mexico on my end.
Yeah.
Really quickly, we think that Mexico is a top priority for the Trump administration because Mexico is benefiting from friendshoring from China. And this is a concern for the Trump administration. And we think that there will be bilateral negotiation between the US and Mexico that will not only involve economics, but also politics related to the border, but also related to the rule of origin, meaning that they want to make sure that Mexico does not rely excessively on Chinese content. And this is a key point. It's my last point there. We should expect under Trump 2.0 bilateral negotiation that will include not only economics and trade, but also politics. And turning now to NATO allies, what it means is that there will be pressure for NATO member to increase their military spending over the medium term. And if several countries do that all together as a share of GDP, higher spending is a form of fiscal stimulus that should be a non-negligible tailwind for the global economy.
Perfect, thank you. And just mindful of time and also changing focuses now to debt. Wiley mentioned something about 2013 with China. If I recall correctly, somewhere around 2013, Ryan, was when the U.S. was also downgraded by the S&P. At some point in time, there was a debt ceiling that was going from 12 trillion to 14 trillion to 16 trillion, or some sort of, at the time, ridiculous number. Neither party seemed to have managing debt on their platform. When does debt finally kick in, or when do people sort of get punished for just constantly spending into the future?
Yeah, there is no magic number. I get this question regularly. That chart you just had up that shows the projection taking off. That's not a new trend. That's largely demographic. That's largely our old age support programs are just going to get more expensive as we have a aging population living longer, healthier lives, and we're going to take care of them, and it's going to cost us dearly. We have had an exorbitant privilege of continual borrowing. We've run a structural deficit all but 2 years of my life. In 1999 and 2000, we did actually balance the budget, and we haven't ever since. And we've been allowed to get away with it. I'm not a debt scold. There is a place for government borrowing. I don't want to treat it like a household budget where we have to balance. It's okay to take on some debt. And in a falling rate environment, it's hard to object in principle. If we're retiring a bond that was paying 6% and we can reissue at 4%, well, seems like free money. The problem is we're not in a falling rate cycle anymore, and it is going to get more expensive. It already has gotten more expensive to issue more. So we are rolling over our debt. We'll continue issuing. This is one upside of that red sweep that we mentioned at the outset. If Democrats held either chamber of Congress, we have seen the debt ceiling, that synthetic limit on how much debt that the Treasury is allowed to issue without further authorization from Congress. That can be used to extract some concessions from the majority party. Well, it's uniform control. I don't know what will happen. The debt ceiling is currently suspended. See what I mean about it being artificial? We can just forget about it, set it aside in an election year. It comes back into force January 2nd, but I expect it will be raised or further suspended, so that won't be an issue. That said, our deficit is high and growing, and Trump intends to continue his tax reform. This was a point of some bipartisan agreement. Harris was also in favor of continuing a lot of the current tax rates on income, but with an offset on corporate taxes. Trump will more likely try to continue everything. It'll be passed through, not to get into too many details, the reconciliation process, which can only be used for fiscal measures only once per year. And that puts a 10-year sunset on it. So we'll debate it again in another 8 or 9 years. I expect we'll continue most of tax policy as it stands, and that's just going to add further to the deficit. No good news here. Voters are not demanding a balanced budget. We didn't hear it from either side. It was just a question of how much more borrowing we will take on. And I get the question, what's the breaking point? When will we hit a number that we just can't issue anymore? When will the auctions fail? We have to plan for that stress case. I don't want to rule it out, but really my base expectation is just malaise. We're going to get into a world of higher debt, meaning higher interest rates, more of a term premium on US debt. We'll still service it, but that higher cost of debt service is going to crowd out other spending. Forget about future tax cuts. Forget about better social services. If you like the idea, like, universal preschool, oh, forget about it. That's not going to happen, not at the federal level. And we'll just fall into this higher inflation, higher tax malaise. We'll never really know the counterfactual, what we could have gained by being more fiscally responsible. But right now, there's really not an electoral penalty for running more debt. So I expect we'll just continue to do so.
Now, isn't there somebody in charge of cutting government spending that we all can put a lot of faith in?
Uh, Without any comments specifically to the current proposal, it's been done before. Obama had the Simpson-Bowles Commission. Bill Clinton, I forget the name of it, but he asked Al Gore to come up with something, and Reagan had the Grace Commission. And it's not hard to find opportunities to cut some spending. The government is what, a $6 trillion enterprise with 3 million employees. We can find opportunities to cut, but then you have to ask Congress to pass some bills to make those changes. And you discover, there are representatives who don't want to see those jobs go away in their districts, or maybe there were reasons that we chartered these regulators. So they'll come up with some interesting reports. I'm sure the social media content will be memorable, but where it actually goes from here, I'm not holding my breath.
I think Ryan highlights something, really important there, which is, and even if they are successful at cutting, they're not, no one is talking about tackling sort of the big four components of the federal budget, which is Social Security, Medicare, defense, and debt service. Like, basically, no politician wants to talk about any of those things, because they, because basically in the U.S., old folks vote. So they're not talking about any of those social service programs, but that's really where the money's going. And my prediction, and I did actually have the opportunity to work for CalPERS, so I was part of a government program for 4 years of my career a few years ago. I dipped my toe in and then quickly got out of the water as quickly as possible because I found it inhospitable. But one of the things I learned about politicians in general is that they usually don't respond until things hit crisis stage, and then they respond, with some alacrity, usually not necessarily effective alacrity, but they'll respond. And so this might be a point of debate where I actually do believe the bond market at some point will call the U.S. government to task. And it's very difficult to predict, as Ryan said, very difficult to predict when that occurs. I think it could occur, when if inflation starts to move the other direction again and get baked into our 10-year yields, that could be a point, that could be a catalyst. I think if unemployment starts to tick up, into levels that are worrying, say 5, 6, 7%, as they did during the global financial crisis, I think that could be where economic growth looks like the trajectory is headed the other direction. That could be a catalyst for some of these, for the bond market and for the auction, the treasury auctions, to back away. Another potential catalyst is seeing international buyers, which are not the bulk of the treasury purchasing, but they're a significant chunk of it, to see the international buyers back away and to see yields rise dramatically at a treasury auction. And when they rise, they tend to rise dramatically, not in a stepwise fashion. I think we're starting to see early indications that perhaps, the term premium is increasing. The real rate of interest, the R star, so to speak, might actually be a little bit higher now than it was over the last 10 or 15 years. So some early indications that perhaps this government borrowing is crowding out other capital investment opportunities. Not really sort of smoke yet, I wouldn't say, but usually by the time in government bond markets, by the time you see smoke, it's already pretty well on fire. And so I do think this is a bit of a tail risk scenario. It's, again, very difficult to predict when it's going to happen, but when it happens, it could have dramatic effects. And so I think that it's probably a bit of a tail risk that all investors should think about. it's also very difficult to diversify away from. It could be part of the reason that crypto is becoming popular, as people are getting concerned about sort of the U.S. dollar. It could be some of the reason that gold was rallying so dramatically before the election. People getting concerned about the level of debt and sort of the possibility that the U.S. government just starts printing money to pay off its extraordinary levels of debt. But right now, the reserve currency is still sound. There's no other real alternative at this point. So I don't think it's a near term or medium term, but it's definitely something to be concerned about over the longer term.
Yeah, now, Wiley, you preempted one of my first questions. Certainly with Elon Musk, as I referenced to earlier, his Department of Government Efficiency, it's not lost on me that the acronym for this department is DOGE.
Doge,
Does anybody feel strongly that cryptocurrency has a lot of legs still to go? And certainly it's a pro crypto Congress, if you will. There was a super PAC that spent a lot of money on crypto supporting candidates. You've got a supportive president now. You've got a supportive advisor. You've got a supportive, somewhat House. So do we feel that crypto still has a lot more runway? Anybody want to jump in and take that difficult one?
I'd say at this point, let's not rule anything out, but it's not ready for prime time. One of my biggest financial regrets, my undergrad is computer science, right? I care about the technology here. In 2010, I read Satoshi's white paper. I learned what Bitcoin was before anyone else was aware of it, and it was basically free if you knew how to set up some scripts. And I thought, this is not a useful concept unless you're doing things you want to conceal or you live in a country without a stable currency. Oh, the fortunes I could have made. And that's a lot of that investment is I think that FOMO. People who didn't really know what they were doing suddenly found themselves incredibly wealthy. So we're seeing investment there. Bitcoin is its own animal. The fundamentals just don't make sense to justify that price, but obviously it has enough true believers who see some source of value in it. The technology has probably some broader uses. I don't want to rule out. I don't see it supplanting any major market currency, but let's keep an eye on it. Let's see it as perhaps a store of value, perhaps a record-keeping system down the line. We certainly won't see it in the US. The Fed has disavowed the central bank digital currency project. They've set it aside. Won't do it without a congressional remit, so it could be more of an emerging market phenomenon.
Great. Now, I am being mindful of time. I want to jump to your closing positions. I want to give everyone a chance to sort of speak about how they're advising clients on position portfolios. I think some of that is ringing through today. So why don't we start, Ryan? I think we've got here policy focus. I think we've covered this. We're just going to skip over to Wiley here. Let's talk about your portfolio positioning recommendations, if you will.
Sure, and I want to make sure to leave some time for Eric because Ryan and I have been dominating the last few minutes of the dialogue. So, quickly on the crypto thing, again, we believe firmly that there should be sort of some fundamental economic driver of return for any investment, and basically those usually boil down into residual earnings. That's equity and private equity. A contractual term, that's interest rates, that's government interest rates, corporate interest rates, high yield, private credit, or rents, that's real assets, infrastructure, things like that. And if you don't see one of those things underneath an investment, we would tend to stay away from it. And that's part of the reason that we've broadly stayed away from crypto. We don't see one of those underlying economic drivers that really determines long-term return for investors, particularly for investors in the pension space, which tend to have a very long-term outlook and are not trying to speculate. Most of the return, or virtually all the return in crypto to date, has been because of speculation. There's not really an underlying either residual earnings, rate of interest, or rent. They could probably make arguments for all three, but really fundamentally, if you boil it down, you don't see that. And so I think crypto is another wait and see. High level and very quickly portfolio positioning, it's stated on the slide. You can see that we've recently gone back to neutral in Canada. We're slightly overweight the US and emerging markets. We're underweight Europe. I think Europe is definitely challenged from a regulatory growth. A lot of their growth is being driven by Chinese demand. That's dried up. As I mentioned, nobody's buying BMWs and Mercedes right now in China because people don't want to be seen in a fancy car. That's not the ethos in China right now. So a lot of that demand that had been, driving growth in Europe has abated. And we are roughly neutral on duration, a little bit, mostly in European duration, actually, over the U.S. Treasury. We're still concerned that the Treasury bond, the yields may climb, thus reducing the short-term returns, as prices decline. And so we're actually more bullish on actually Canadian government bonds than we are the U.S. government bond, and certainly very cautious and riskier credit. Again, in a positive but slightly, where we see growth perhaps starting to slow into 2025. Still positive, still growing, but maybe not at the same rate. We think that's maybe not the best environment to load up on credit.
And you want to speak a little bit about some sort of new policy alternatives and things coming down the pipeline, perhaps?
Sure. This will just take a quick second, but we have a lot of work going on in the pension space. We have one of the first sustainable target date funds available in Canada, managed out of our Toronto office. It's had great returns, and in the U.S. it's very challenging right now in the sustainability space, but outside the U.S. we're still seeing demand for sustainable options, and including in Canada. So our sustainable target date strategy has been quite popular. We are seeing trends to include more alternatives in defined contribution plans. They've been in DB plans, defined benefit plans, for many years. People have seen the return differentials, and so we're starting to see that trend, and we're supportive of that, quite supportive. It's obviously requires some work and there's some work to be done to make sure that liquidity, risk, and fees are all appropriately addressed. But we think those are very tackleable goals. And including annuities have some of the same challenges as including private assets in retirement plans. But we think for many investors, it's sort of particularly the bulk of the sort of middle income investors, annuities could have a proper place in retirement plans. And then finally, we are seeing continued demand across the board, across all spectrum of investors, retirement investors in particular, for ongoing income. It reduces timing risk, so you're not having to sell assets to fund your retirement. People don't like to do that. It introduces timing risk. When markets are down, you're having to sell. So regular, steady income kind of helps reduce that, and we see steady demand for that. So those are the big trends that we're supporting and really seeing in our marketplace.
Great. I'm going to give it to Eric for final word on portfolio positioning for a quick round of rapid fire questions.
So there's a lot of uncertainty for investors. There's Trump, trade war, crypto, inflation risk. But what's important is discipline. It's to avoid having an excessive exposure to idiosyncratic themes. What's important is to focus on the big picture, which is the following. We are in an environment where the global macro is compatible with higher for longer due to strong demand and the lack of appetite for fiscal consolidation. In that context, there's three implications for our investors. The first one is there is more U.S. exceptionalism looking ahead, but it's also important to have a diversified and balanced portfolio. And in the context of higher for longer caused by strong demand, equity across the globe remain attractive over the medium term. Emerging market, same story. And the last point is it's important to have useful diversifier in a portfolio. Of course, there's traditional government bonds to protect against weaker growth, but on the other hand, there's also tools that can be used to hedge against tail inflation risk. There's some equity market that provide better protection against high inflation, and there's also commodities. So balanced portfolio is the key, should be the key focus with discipline for investors.
Great. Thank you, Eric. A quick rapid fire question for all of you. Where is your central bank rate come June 2025? Let's start with Wiley really quick. You only get one word to answer this question. One number.
4.25.
Ryan?
3.75, I believe.
And Eric, your own central bank?
Well, we look more at the Fed. It's 3.75 for the Fed, and for the Bank of Canada, it's more cuts than the Fed.
Okay. And then something that affects all of us, what is the CAD USD, which way is the CAD USD exchange rate going?
Weaker CAD, but the Canadian dollar is cheap compared to the US dollar, so there's limited downside.
Ryan?
I don't have a numeric forecast, but stronger dollar.
Yeah, I would agree. Although I also agree that I think the CAD is kind of at it looks like a pretty stable landing spot. I don't see a lot of downside.
Perfect. Well, listen, gentlemen, I want to thank you all very much, Wiley, Ryan, and Eric, for your insights. They've been wonderful, and hopefully that's useful. Anybody who's been watching the webinar today, feel free to reach out to any of our speakers if you want to have follow-up conversation or through ACPM. Thank you to Matthew Potter for the technical support, and then finally Corinne and Judy. The work you do with ACPM is well valued by your members, and we appreciate you giving us the opportunity to run this webinar today. And I often hear that the best webinar is one that ends on time. So at that, I'm going to say thank you and take it to wrap it up.
Yeah, well done, Steve.
Yes,
Thank
great
you very
job. Great
much.
job, all of you. And the timing was perfect. We had big news this month, and you've managed to summarize some really key points in just an hour. Thanks to those who've chosen to join us today. We really value your time, and we will see you next time. Take care, everybody.
Bye.
Bye, everyone.
Bye.
Bye-bye.